Welcome back to the deep dive. So, if you're tracking the market today, you've probably looked at the spot price and thought, well, we're still stuck in neutral.
We really aren't.
Bitcoin's in this tight band. It's oscillating in a way that just feels like a permanent holding pattern.
It absolutely looks like stasis.
Yeah.
We've been calling it animated stasis. There's just enough movement between, say, 92 and 94,000 to keep you watching.
Right, to keep you on your toes.
Exactly. But it's coiled, waiting for today's macro news. And what our sources are showing is that just beneath this flat surface, a really significant structural revolution is happening. It's quietly upgrading the entire financial foundation.
Okay, let's unpack that, because this great bifurcation is the core thesis from all the intelligence today. On one side, you have the speculative retail crowd. Their interest is, it's tepid. They're sidelined by all this macroeconomic uncertainty. But the other side, the institutional, structural side, is just hitting the accelerator. The financialization of Bitcoin is moving at a velocity we really haven't seen before.
It's the institutional handover, and it doesn't care if the price moves $2,000 up or down today. So for this deep dive, we're focusing on the hard evidence of that infrastructure build-out.
Okay, what are the key areas?
We're zeroing in on three things. First, the Tier 1 banking integration, which is unprecedented. Second, the new, more sophisticated phase of the corporate treasury wars. And third, the sort of Darwinian split we're seeing in the mining sector.
And it all leads up to that big FOMC decision later this afternoon.
That's the catalyst.
We have to start with the banks. The data is just overwhelming on this. The entry of major U.S. commercial banks feels like the most consequential development right now.
It is.
It's like we're finally closing the book on that old Operation Choke Point narrative.
We are. And the landmark development we're tracking is PNC Bank. Now, this is a top 10 U.S. financial institution.
A huge name.
And they just launched direct spot Bitcoin trading. But this isn't for everybody. It's specifically for their high net worth and ultra high net worth private banking clients. This is the capital that actually moves markets.
And the mechanism here is key, isn't it? PNC isn't acting like some scrappy startup. They're not trying to reinvent the wheel.
Not at all. They're using a white-labeled crypto as a service, a callous model, that's powered by Coinbase.
Okay, so Coinbase is the engine.
Exactly. But what that means for the ultra-wealthy client is total seamless integration. They see their Bitcoin holdings right there in their single portfolio view, sitting next to their bonds, their equities.
So it's completely frictionless for them.
Completely. But that raises a really critical question, doesn't it? If they're using Coinbase, aren't they just outsourcing the risk instead of truly absorbing the asset?
Yeah, that's what I was thinking. It's kind of like white labeling the operational headache.
It is, but for this very specific demographic, the point isn't about absolute control. It's about what we call trust arbitrage.
Trust arbitrage. Okay.
For a conservative investor, the barrier was never Bitcoin's volatility. It was the counterparty risk, the fear of using an unregulated, crypto-native exchange. PNC is monetizing that trust gap. They're wrapping Bitcoin in the safety blanket of a federally chartered bank.
So they're basically saying, you trust us with your stocks, you trust us with your bonds, you can trust us to hold this too.
You got it. It de-risks the asset psychologically. And that is what could open the floodgates for this conservative capital. This PNC rollout is the proof of concept.
So if this goes smoothly,
if they execute this without any regulatory friction, we fully expect a cascade of similar launches from their peers. Think Truist, U.S. Bank, all through 2026. This is what permanently bridges old and new finance.
Now let's contrast that speed-to-market approach with Citigroup. They also announced a roadmap, but their custody services won't launch until 2026. That's a much longer timeline.
A much longer timeline because Citi is taking the complete opposite route. This is the build model, not the buy model. They were vertically integrating with their own proprietary platform. It's called the Citi Integrated Digital Assets Platform, or CDAP. And this is way more ambitious than just custody.
So what is it then?
It's a full engine for key management, for tokenization, for connecting to all kinds of blockchains, public and private.
So that delay into 2026, that just reflects the sheer complexity of building this into a GSIB, a global systemically important bank. This isn't just an add-on feature.
It's a massive retooling. And this is where you see the bigger picture. With Citi, Bitcoin is acting as the Trojan horse.
The Trojan horse? How so?
The CDAP infrastructure isn't just for holding Bitcoin. It's designed to eventually support the tokenization of real-world assets, RWAs, and traditional securities. They're positioning themselves for that on-chain economy that SEC Chair Atkins talked about. They want a piece of a future multi-trillion-dollar market.
Okay, so let's shift from the banks to the corporate balance sheets. The corporate treasury wars have really evolved. It's not just buy and hold anymore. It's sophisticated, it's competitive.
And MicroStrategy, MSTR, is still setting the pace. I mean, the latest numbers are just staggering. They added another 20,356 BTC.
Wow. And what's their total now?
They're at nearly 500,000 Bitcoin. 499,000. That's almost 2.5% of the total supply. No one else is even close.
That number is just, it's hard to comprehend. And the way they're funding it is the real story here. It's these low or zero coupon convertible notes. Can you just break that down simply for us?
Sure. Think of it like this. MSTR is issuing debt, but with an incredibly low interest rate, sometimes zero. So they're borrowing fiat capital at basically no cost, betting that Bitcoin's future value will dwarf that tiny interest expense.
So they're using cheap dollars today to acquire a very scarce asset for tomorrow.
Precisely. And they've paired that aggressive leverage with a really smart defensive move. The sources highlight that MSTR has a $1.4 billion cash reserve.
And that's just to cover their debt.
Specifically to cover 21 months of their obligations. It's a risk buffer.
Yeah.
It signals to the market that they can survive a downturn without having to dump their Bitcoin.
Now, speaking of valuation, the sources point out this MNAV premium is compressing. What does that tell us about how the market is looking at MSTR right now?
It tells us the market is maturing. MSTR used to trade at this huge premium because it was, the only real way to get leveraged Bitcoin exposure.
Right.
That premium is shrinking. The market is pricing it more like a leveraged closed-end fund now. The speculative hype is fading, and it's being replaced by a more sober valuation based on the assets they actually hold.
And we're seeing new players with different playbooks. 21 Capital, XXI just debuted on the NYSE, led by Jack Mallers, backed by Tether. It dropped 20% on day one. Why the hesitation there?
Well, there's some general skepticism around SPACs, but it's mostly their ambitious thesis. They're trying to be an operating company, generating yield through brokerage and lending.
So not just a passive holder like an ETF.
Exactly. And the market drop suggests investors see the high execution risk in actually building those businesses from scratch. It's a lot harder than just buying and holding.
Meanwhile, you have these mini MSTRs popping up. ProCap Financial with 5,000 BTC, American Bitcoin Core with a big jump in their holdings.
And this is where this new metric becomes so important. Satoshis per share, or SPS. It's quickly becoming the gold standard for forcing discipline.
Okay, explain why SPS is so powerful for aligning incentives for shareholders.
It's all about scarcity. If management issues new shares to raise money, they have to buy enough Bitcoin to increase the Satoshis per existing share after dilution. If they're inefficient, their SPS goes down, and it directly hurts shareholders.
So it forces them to be laser-focused on accumulation with every dollar they raise. No complacency.
Exactly. And we're also seeing capital coming in driven by ideology. Strive Asset Management just launched a $500 million offering to buy Bitcoin.
And they're known for their anti-ESG stance.
Right. So they're positioning Bitcoin as an ideological hedge against what they call woke capital. They're tapping into a whole new allocator base that sees Bitcoin as a hedge against centralized political influence, not just monetary policy.
Fascinating. And then you have a company like Hyperscale Data, an AI data center firm with a $75 million treasury and a goal of holding 100% of their market cap in Bitcoin. It's a whole new identity.
It is a complete commitment.
Okay, the mining sector. The capital demands post-halving are just brutal. And it's forcing this severe divergence in business models. It feels like financial Darwinism.
It is. We're calling it the great hash rate bifurcation. And you're seeing two completely opposite strategies emerge. On one side, you have CleanSpark, CLSK, the pure play high beta bet.
And they just upsized their convertible notes offering to,
Yeah.
what was it, 1.15 billion.
Massive $1.15 billion.
That is a dizzying amount of leverage just to buy hardware. What's the logic there?
Their logic is winner take all. They're betting that the Bitcoin price will surge high enough to justify that debt, allowing them to capture market share with the most efficient new hardware while their competitors are struggling.
So it's maximum operational leverage. If the price goes up, they crush everyone.
But if it stagnates, that debt becomes a serious existential problem.
Now contrast that with Marathon Digital, MERA. They're making a clear pivot toward AI and high-performance computing.
A total hybrid pivot.
Yeah.
They're repurposing a big chunk of their power capacity to offer compute services. It's all about risk management.
How so?
Marathon is diversifying. They're creating stable, fiat-denominated cash flows from these compute services. They're moving away from being just a volatile commodity producer.
And trying to position themselves more like a digital infrastructure REIT or something?
That's the perfect analogy. They're seeking a higher, more predictable valuation multiple. They're saying, we're a tech company that also mines Bitcoin, not just a miner.
It really shows the stakes.
Right.
You either go all in on leverage, like CleanSpark, or you diversify, like Marathon.
There is no middle ground left.
So we see these foundational upgrades in banking and corporate treasuries, but we can't ignore the pain the miners are feeling. If the price does stall, how does that billion-dollar debt load affect the hash rate and maybe the spot price floor?
Well, that debt is a constant downward pressure. Miners have fixed costs. If the price doesn't move, they are forced sellers. And right now, the price is just incredibly coiled ahead of the FOMC meeting. The technicals show this extreme compression. A big move is coming.
We've seen that 24-hour range. It's been incredibly tight. $92,000 is the strong support. $94,000 is that clear resistance wall.
It's a volatility implosion, right?
Exactly. The asset is barely moving, but implied volatility, what the market expects in the future, is rising fast. The market is holding its breath. And a breakdown below 92K is technically dangerous. It could risk a quick drop to the next support around 84,000. And that catalyst is the FOMC decision at 2 p.m. Eastern. The consensus is that a 25 basis point rate cut is almost fully priced in.
It's 96% priced in. The cut itself is not going to move the market.
So what is the primary risk that everyone's hedging against?
The risk is the hawkish cut scenario. No one's worried about the rate decision today. They're worried about the guidance, the Fed's dot plot, the commentary. If Powell signals a pause in easing for early 2026, for example,
that would be the hawkish signal.
That would immediately dampen all risk assets, including Bitcoin, no matter what they do with rates today.
And while this is all happening, we've got these two powerful but totally conflicting valuation models hitting the wires. Standard Chartered, who is super bullish, just slashed their 2025 price target from 200,000 all the way down to 100,000.
It's a huge recalibration. Their thesis is all about adoption speed. They now think corporate adoption outside of MSTR has been slower than they expected.
So ETF flows are the main driver, and that's just a slower process.
Exactly. They're walking back their forecast based on that real-world uptake.
But then, on the other side, you have JP Morgan. They just released a gold parity model suggesting a much higher target of $170,000.
JP Morgan's thesis is the inverse. They argue that as this institutionalization, the PNCs, the CITIS, lowers Bitcoin's volatility and increases its liquidity, its fair value should mathematically ratchet up toward gold's market cap.
So for them, the more boring Bitcoin gets, the more valuable it becomes.
That's it. It's a battle between the speed of corporate adoption and the maturity of the institutional rails being built.
And that structural strength is still showing through. Spot ETFs had over $151 million in net inflows just yesterday,
which shows strong institutional positioning for recovery, even with the market waiting on the Fed. We should mention the counterpressure, though.
Right.
That inflow is being partially absorbed by supply overhangs from long dormant wallets waking up and the government selling off those seized Silk Road assets. That's capping the upside a bit.
Okay, so let's synthesize this. What's the overall conclusion for today?
Bitcoin is firmly in a handover phase. Weak hand speculators, distressed miners, are being systematically replaced by strong hands. Tier 1 banks, well-capitalized corporate treasuries. The critical takeaway is this massive divergence between the flat price and the booming, permanent infrastructure being built underneath it all.
So the structural upgrade is happening regardless of today's price signal from the FOMC.
It is, and that leads to the final provocative thought for you to consider as you watch the news today. If a giant like Citi is spending all this capital to build their side app platform, not just for Bitcoin, but for the eventual tokenization of all global securities,
right,
does the true long-term value of Bitcoin lie less in its volatility as a digital gold and more in its essential non-sovereign role as the foundational clearing and settlement layer for a future trillion-dollar on-chain financial system?
A huge question. We'll be back tomorrow to dive into the implications of the Fed's decision.